Trade Justice Podcast 583. Justice Brothers with you. Going to talk about a little uncertainty. Maybe not NVIDIA, maybe not Apple, maybe a bunch of other stocks. It's an interesting backdrop, Matt, to have the market at all-time highs, and yet the fear gauge with the arrow in the fear. I don't know if I've ever seen that. I find it fascinating. We'll talk about that throughout the podcast at different points. But before I ask you how you're doing, Tackle Trading sponsors this podcast. Amazing community, amazing products, a great newsletter that was put out this weekend, talking in depth with analysis and charts and figures and data about lots of subjects that we will touch upon in this podcast. It's a great pro community. Give it a try. Go to tackletrading.com, go to the store tab, sign up for a 15-day free trial to see if it is the home for you. So now, Matt, with that out of the way, how you doing?
I'm doing good. I want to talk about Tackle a little bit, though. Learn, trade, connect, succeed. That's the motto of Tackle Trading. We believe in teaching people before you apply anything. Learn, trade, which means you have to apply. That is the combination of success. Get your butt in the seat, learn how to do this. Apply it equals success. And then you're going to meet a bunch of great traders and investors along the way in the Tackle Trading community. So if you are ready to be a part of the Tackle Trading community, if you're just looking for picks, if you're looking for an amazing newsletter, the Traders Report, or any of the plethora of content we put out for our community on a week in, week out basis, you can go over there to tackletrading.com and you can sign up for a free 15-day trial, test out all the goodies, including getting into that option success training coming up in a few weeks from now so that you can learn how to be that market assassin as well.
Well, listen, Tackle Trading, listen, Matt and I could be doing a lot of stuff in life. We love this community. You should, the amount of things that we talk about, just how much we love this community, man, just come be a part of it. Come be a part of it. We have fun. At least we try to.
We have fun.
You know, when my left brain brother doesn't take over with analysis on a Friday night at 9 p.m.
Sometimes you got to break down some combination charts, bro.
Well, listen, and you and I approach Fed meetings a little differently. I'm a little bit more, I don't know, look.
Disillusioned.
Disillusioned is a good word. Disillusioned. And there was nothing in this Fed meeting this week that changed that.
No, although
I did get a kick out of Jay Powell throwing the U.S. government's data under the bus. I did appreciate that. But Matt, give us a highlight recap of the Fed meeting this week.
Yeah, central bank week, obviously, but man, it was a big week this previous
week.
My
gosh, it was so busy this week.
Big week. I mean, central bank was not even the most important news in my estimation. The most important news was out of Apple and Apple Intelligence, quite frankly. That kickstarted, I don't want to say kickstarted because the second phase in AI is already ongoing, and that was just throw gasoline on that fire there. Wonderful news coming out of Apple and obviously technology moving. But, when it is central bank week, they are the number one player in the market and for good reasons. They control the United States dollar. They control the supply, the demand, the interest rate, everything about the dollar. So when you're looking at the central bank this week, first and foremost, nobody in the market expected them to do anything this week. Everybody expected them to basically hold pat and stand firm on the pause. They've been in a prolonged pause for a very long time. That shouldn't be surprising to anybody in our Trading Justice Tackle Trading community. It's something we talked about for a very long time that they were going to do. And so it's not surprising that they continue that. But it was going to be a very interesting Fed meeting this week because even though there was no expectation.
Yeah, and I would like to throw it the potential to be really interesting, potentially.
Yeah, because even though there was no policy updates, this is the meeting where you do get the SCP. And the SCP lays out the future expectations of what the Fed sees from an economic perspective, an inflationary perspective, and certainly an interest rate perspective. And why that's important is the problem going into the Fed this week was, and I'm not saying it was a problem for the Fed, I'm saying it was a problem for the market, was there's not a crystal clear outlook on the expectations on Fed policy. And last week in the podcast, I talked about it being a mixed market because there is not consensus on the path of policy, which means there's some uncertainty regarding when they're going to cut, if they're going to cut, and when that and what that means for the marketplace. And so even though there was no expectations for the Fed to act, there was some hope, I want to say, that the Fed would clarify the path to policy, which quite frankly, if you listen to any of the Fed speeches in comparison to what Jay Powell says on Fed Day over the last 6 months, the Fed has painted the picture so far to the right, so far to the left. They've been all over the place with basically what they need to see. And so in terms of that expectation, did they provide that in the SCP? Did they provide that expectation in Jay Powell's press conference? And unfortunately, no.
The answer is no.
They added further uncertainty on top of it, because what they did do and what they did say doesn't make sense to the my left brain here. And so, Mark, in terms of what they basically maintained the policy, number one. Number two, they modified 3 words in the actual policy statement while also reducing the quantitative tightening announcement from the previous statement. And so obviously we're not dealing with a lot of changes here. For example, Mark, in recent months, there has been this is one of their change, a lack of, now they use modest. Okay. So I doubt we're going to get to up or over that one. And then when they removed the announcements of quantitative easing, they basically said now backed securities. And so not a lot of changes on the policy statement. Now, was there any changes on the SCP? And this is where the path of policy starts getting into foresight here. The answer is no. What we did see is they maintain their projections from now from a GDP perspective as well as an inflationary perspective. There's not a lot of massive updates there from where we were 3 months ago. But what we are now seeing is we are now seeing that from a interest rate cut perspective in the dot plot, where the Fed expected 3 cuts, now they only expect 1, maybe 2 cuts. And so nothing really changes from a projection perspective, but they do change, despite the fact that nothing changes from a projection perspective, they do change the expectation from a cut perspective. And so that added a little bit more uncertainty, because when you look at the actual SCP, when you look at the dot plot, when you look at the policy statement, nothing really changes in the projections, but they remove potentially 2 cuts from the dot plot. And then when you listen to the press conference, they kept the data dependency in the marketplace, which tells us they need to see more data, but the data in their SCP didn't change despite the expectations on cut changes. And I know that's a mouthful, and I know I maybe lost some listeners along the way in explaining.
You lost 99% of people.
But let me just say it like this. If you're confused and I'm confused on that,
that's the thing.
What do you think the market is?
What do you think the market is? You know, and we need to find a new phrase than market, you know, because there is 2 markets right now, right? There's 2 markets right now, and it's not the first time. And it's not as easy. It's back in the day, Matt. And when I say back in the day, I'm talking like post-pandemic. I would talk about 2 markets. I would talk about stocks, and I would talk about the underbelly, the high growth, the stacks, right? And that was an easy separation, right? That was an easy separation. It's much more complex when you have the Dow 30 as part of the other problem children. That's a little bit weird. That's a little bit weird, you know? But you got a lot of stocks struggling out there, and you got a few stocks just absolutely killing it. And so it's like most of the market is confused, but some of the market isn't, right? Do you get what I'm saying?
Well, I think a lot of people are confused in the market, but this is not the first time we've seen that. And I wrote about that in great detail in the newsletter this week. So where do you want to go with that conversation?
Well, we'll talk about that in a second. I just wanted to lay that backdrop in first, because what I wanted to lead into is that we had other economic data this week, Matt.
Mm-hmm.
And we had the Fed meeting, but we also had inflationary data this week. We had some other economic data points this week. Everything, Matt, across the board missed. Inflation missed. Other things like consumer sentiment missed. Unemployment claims missed, produced one of the highest numbers in several months. So we had a combination of weak economic data and weak inflationary data. And Matt, honestly, if you would have asked me at the start of the week, how did your average stock do with those inflationary readings? Not referring to AI, not referring to the high flyers, but your average stock. I'd have been like probably pretty good week. Was kind of flattish on the week when it was all said and done. What do you think the market's trading on these days? Referring to not AI, referring to everything else right now.
It's trading on the lack of clarity regarding the path of policy, which whenever there's any concern in the market, it's a self first, ask questions later type environment.
And so but we've seen I've seen, how we have the sayings in the market, good news is bad news is good news, bad news, and stuff like that. I've seen every variation of that over the last 3 weeks, Matt. Mm-hmm. I've seen strong economic data rally the market. I've seen strong economic data sell, have the market sell on it. I've seen bad economic data rally the market. I've seen bad economic data have the market sell on it. It's a messy backdrop. Break down the specific data that we had this week.
Well, let's go on that question on your little statement there, because I think it's important. So the market has bought good data. The market has sold good data. The market has sold bad data. The market has bought bad data. The market's been all over the board, but over the last couple of weeks, haven't we been describing a mixed market? In fact, didn't we spend the entire podcast last week just talking about the mixed market? So that's not something new to this week. The market did not get confused this week. The market was confused going into this week, and the Fed added to that confusion. And so when the market
perpetuated that confusion, you think they added to it this week? You think the market
absolutely fundamentally?
Okay.
Yes, 100%. I do. Of course, I
do.
But to me, you're talking about I've seen the market do this and I've seen the market do that. You're right. But again, what did we talk about last week? The market is confused. And what did I say? The market is confused because there is not a consensus on the path of policy. And the Fed is not providing.
And you said it will not.
Specifics.
You specifically said last week that it will remain confused until it does.
Policy. And unless the Fed is going to clarify the path of policy, the market is going to be confused. And you can look at it technically, you can look at it fundamentally, you can look at it economically, but you just described it. I've seen the market buy it. I've seen the market buy good data. I've seen the market sell good data. And yes, those environments do exist, but they don't exist every other day.
Yeah, that's the thing. Matt, we would not be talking about this. I don't know what we would be talking about. Maybe we would have led off with gold. Did you see gold? They held another sell-off that went
up. We'll talk about gold here in a minute.
But had this been and this is a big point, we would not be talking about and spending this time if this was just a few day occurrence. But this has been going on for a month now. A month now. I mean, you go look at the Dow chart, which is, I guess, the new underbelly in the market, and you go look at that wild ride, and tell me. I mean, these are 30 of the biggest freaking companies in the world. This is not Kathy Wood's collection of fun things to put in an ETF.
Yeah, but
right?
like, but okay, but like I never get confused that something's selling. Like you break support, you're going to stop loss hunt. The algorithms take it to the ultimate conclusion. So like that's not going to confuse me. But I I guess my point is like on the mixed marketplace, I don't think we should be surprised or shocked when a market sells when there is uncertainty existing in the market. That's 2 + 2 in the market. There's nothing that the market hates more than uncertainty. It's the number one thing the market hates is uncertainty. The market does not hate bad data. It prices in bad data. The market hates uncertainty because in uncertain environments, you cannot project fundamental, technically or economically. You need to be data dependent to be able to get to the point where you can project. And so I just, more than anything, because, for example, in the newsletter this week, I wrote about this. I said, basically, in historical moments where there is uncertainty, the market sells. This is not unheard of. This is 2 + 2 in the marketplace. What is unique actually is that over the last year and a half, we've seen the market hold up in environments where historically it would sell. And so the Dow selling is not surprising to me. The cyclical areas of the market is not surprising to me. You know, it may be a little bit of the velocity of that is a little bit outlandish, but it's not surprising because, again, in moments in history, and we talked about this just last week, where the markets are confused and there's uncertainty and the markets are mixed, the path of least resistance is down. Sell first, ask questions later. What is unique is that, quite frankly, Mark, if it wasn't for AI and tech and the large moat argument over the last year and a half, everything would have sold, and you just would have compared it against the 18% sell-off in August of 2015, or the 57% sell-off in the subprime meltdown, or the 8, 10, 12, and 13% sell-offs you had due to the European debt crisis from 2010 to 2015. It would have just behaved that exact same way as it did in the pandemic, where everything sold. So it's not the fact that mixed markets lead to confused markets, which leads to downward pressure in price. That, once again, is 2 + 2 = 4 in the market. It's the fact that you have this unique environment called AI that is creating divergence in the market, and that is confusing a lot of people when they see one area of the market.
But Matt, let me dive into what you just said. Just one
market's not.
One layer. It's so you're arguing not just that, you know, obviously AI benefiting AI, but it's also creating the backdrop of a stability even in marketplaces that because of the presence of this once in a generation theme in the market, that in uncertain times, yes, Dow's going to have.
Is when we look back at the divergent behavior that we first identified in these unique environments where you get mixed markets and some areas of the market, like you said, the Dow selling really, really, really hard, right? And when you look at it from a technical perspective and you look at, say, the Dow over the last couple of weeks, or you look at the, let's say, RTY over the last couple of weeks, you see RTY selling off pretty good, breaking through a symmetrical triangle. The Dow obviously going through some neutrality right now as well. You look at those environments.
Yeah, neutrality, but wild neutrality.
Yeah, it is wild neutrality, but I wouldn't say that the Dow has been wild crazy in the last week and a half, 2 weeks. What is different is it has, quite frankly, diverged from what the SPY is doing. But my point is this: we're not as confused as, and I'm not saying you and me, I'm saying markets. They're not as confused as you think, is my point.
And I love this. And I want to emphasize that, like, you know how, like, I don't know, like when you're watching children's programs and they have like some special bell or whistle to illustrate a very key learning point, right? I wish I had a sound, because this is the point of the whole podcast. We're going to talk about some other aspects, but I think this is going to be the key point of the whole podcast, that they're not as confused as you think, and they're more stable than they would be otherwise, referring to other markets, not the cap weighted S&P 500.
In like environments, when you have a macro, and again, think top down here, when you get other environments and you have macro concern over one reason or the other, Mark, everything sells. Everything sells in uncertainty, because the environment is sell first.
Yeah, I mean,
questions later.
Matt, you want to see a market that, like, if you go look at France's market this week, there's real uncertainty, and it's down 10% this week, right? We're not seeing that, right? We're not seeing anything close to that.
But of course we're not seeing anything like that. But again, my general point is, in those environments like the French uncertainty, everything in France sold. It wasn't like utility stocks in French sold, but consumer staple stocks went up. It's not like, oh my goodness, the tech
point
went up in France. Everything went down.
Everything went down.
Everything went down, because when true volatility hits the market, there's not a, ooh, let's think about the mode of this, or ooh, let's think about the fundamental condition of this. It's no, get out, ask questions later. That's
a great point.
Okay, that's not what's happening here, and that's I think what people are missing here is, in these environments where you have uncertainty existing in the marketplace, things don't hold up initially in that. It's everything sells, and then the things that are safe havens will recover faster.
Yeah, there you go.
Outperform, but everything initially.
And we're not seeing anything close to this.
Again, my point is this: everything sells. But the point here is, not everything is selling in America, in the American markets, and not everything is sold in the American markets outside of this movement to the downside. And in this movement to the downside, we weren't having a divergent conversation against the RSP. We were having a divergent conversation with the RSP when the market started trending bullish again, because everything started going back up, but it was being led by tech. And that's my point. When you look at the divergent behavior, and if you'll just give me a second on this very quickly, when you look at the SPY against the RSP, okay, again, can we both agree on this, Mark, that in history, when market volatility hits due to uncertainty, regardless of if that uncertainty is minor in the moments or massive historically, in moments of uncertainty, what does the market do?
It sells.
It sells. Okay. Now we know that because we've seen it a billion times, right?
Because we've seen it a billion times.
Seen it a billion times.
You know, and whether it be, and it's not just when it's markets, whether it's bonds or stocks or precious metals or oil, it sells.
We haven't seen it a billion times in the last 18 months.
No, you've seen something different.
We've seen something different. And everybody keeps, before you jump in, let me finish my point.
Okay. There's so many things I want to say.
I know, but before you jump in, let me finish my point. Right now, everybody is describing the market as confused, correct?
They're either confused or this is a bullshit market because there's so much divergence. Right.
Okay. Because in these environments, historically, everything would be selling. So if tech was not going up right now, but tech was going down, nobody would be saying the market.
Nobody would be saying the market. Yeah, they'd be like, oh yeah, okay, because it makes sense in their brain.
They would be like, oh yeah, this makes sense. It's a mixed market. There's a lack of path of policy. There's some uncertainty existing. Sell first, ask questions later. We would go into the market correction language, right? The same way we went into the market correction language the last time we started seeing that significant selling behavior. But once again, we're not seeing that this time because, again, the markets are not as confused as you think. There's a difference. And the difference is AI. And I know I'm the AI guy, but that is the difference.
You called you AI guy before
No,
I did in the
you were
show.
going to say it. I had.
I know
I
you bastard.
I see. That's how you kill something over time. You have to own it for a second, then you can kill it yourself.
It's true.
Okay, but in terms of that's the unique thing, Mark. When you look at when this first started happening, okay, there is a unique pattern here in times of uncertainty. And we'll talk about how uncertainty exists and how it creates themes on the back end of it. But when you look at the SPY here, okay, look at RSP. Now, RSP is the equal weighted index. Everything's equal. Okay.
The average stock.
SPY, and these are the exact same 500 stocks. SPY is a weighted index, and it gives a heck of a lot of credibility and credence to big cap tech, correct?
Yep, correct.
So what have we seen over the course of the last 2 months here? Well, Mark, from a technical perspective, okay, when you're looking at just the last little bit, okay, just the last little bit since let's go first of the year, okay. So from the first of the year until now, all right, the first of the year, the S&P was bullish, RSP was bullish, right? And you'd say, okay, Matt, that's not 2 + 2. Of course that is. They're the same index. They should both be bullish. And I would say I agree. So why am I bringing it up? Because there's unique situations where they don't align and they tell us something. And so for the first 3 months of the year, big bull run in both RSP and SPY, everything was cooking, everything was doing good. Utilities great, staples great, tech good, industrials fantastic, energy fantastic, finance. Throw a dart at the S&P and you made money in that environment. It was a really, really, really constructive trend. The eventual pullback was the exact same. The pullback in March was the exact same on both SPY and RSP. And again, you're like,
yep.
Matt, why are you talking about this? You're looking at the exact same index. Of course, they should do the exact.
And the rally for the next 2 weeks was the same.
The rally was the exact same thing, except you started to see something different.
And then you saw something different.
Okay. And it wasn't after the rally. It was during the rally, Mark. During the rally, RSP set a lower level of resistance, whereas the S&P actually set a higher level of resistance. That is divergence within the same index. And when you see that divergence, when the S&P sets a higher level of resistance in the same time frame that the RSP sets a lower level of resistance, the RSP is losing momentum, S&P is gaining momentum, and there's only one way that can happen, and that is big cap tech. That is the only way that can happen, is big cap tech. Okay, now, obviously, you start to see it on RSP. RSP starts coming down, whereas SPY starts going up. All right. So what you're actually seeing is everything in the market is actually selling, except big cap tech, which equates to damn near 30% of the entire S&P 500. And when you're looking at big cap tech, literally just a handful of stocks represent a massive impact on the overall market itself, but it doesn't have that impact on RSP. Now, so we see the divergence. We know the divergence is existing fundamentally. Now, why is it occurring? It is occurring.
Well, Matt, before you get into why, I would just like to point out. So this situation, and we'll talk about this more in a second when we compare it to 2023. This situation's kind of unique in the last couple years, but it's not unique in the last couple years, if that makes sense. Like you would see breadth issues, because I did a huge breadth study last year when we were having a similar situation, and market breadth situations end up being very negative for the market almost all the time, because eventually something gives out, and it's usually the breadth up top. But that's not what occurred last year. Mm-hmm. And as such, I was like, well, this feels like last year. And so this situation is uncommon in the history of markets, but it's not, and keying off something you said, which I think is such a huge, massive point, it's not uncommon since AI became the dominant theme in the market.
And that's the thing the market isn't getting, Mark.
And that's what the market's not getting.
The market is so confused that the SPY is going up and RSP is going down. And they're like, how can this be the case? Because again, tech wouldn't go up historically. It would have been going down as well. But Mark, when you go back to 23, we saw something unique occur.
Yep.
And I think this is going to be a pattern in the future that we anchor against, quite frankly. And so when you go back to the past here, right? And I'll just kind of, for those of you listening here, we're looking at a weekly chart of the S&P, and we're looking at kind of the beginning point of 2023. All right. On the right-hand side, we got the RSP, that's the equal weighted index, and we're looking at the exact same time frame, the first 6 months of 2023. So once again, we're going to be looking at 6 months of data here, 2023, first 6 months of data. And why this is important? Because this is the first time we saw this divergence between RSP and SPY. And I think it's important because if you can understand the behaviorals behind it, you can understand there's a couple trades here to kind of think about. When you're looking at the first of 23, Mark, it was an extremely similar situation to the one we're going through right now. In the first quarter, we had a big upward movement in price. The entire market went up. RSP, SPY went up. In the second couple months, February, March, RSP, S&P went down. Both of them very, very similar. But something in March occurred, and it wasn't just one thing, it was two things. But something in March occurred to create divergence. And it created divergence for about 3 months in the market. It was not a short time frame, Mark. It was about 3 months in the market. And the two things that occurred to create the divergence, and what the divergence was the S&P started trending aggressively bullish, whereas the RSP went into neutrality stagnation for 6 months. So what created this was two things. Number one is you had the Silicon Valley regional banking crisis, and that created a lot of volatility and an uncertainty in the marketplace. And if you'll think back to the March, April of 23 conversation, it was all Silicon Valley. It was all regional bank. It was run on banks. There was massive, massive concern.
And Matt, I want to put a little backdrop to this because it is important to understand this historical time period by realizing that just a couple months before, the whole of Wall Street was entirely bearish.
Everybody.
Ridiculously bearish. You had people like Michael Wilson talking about a great earnings recession that was about to hit us. And so
when you asked me about that, what did I say? No.
Oh yes. Well, you made a great call on that. But Wall Street as a whole really bearish. And so then you have the banking crisis in 2023 occur. You have a insanely bearish Wall Street of gloom and doom, but you also had something called chat. What is it called?
Before you even get into that, though, it's really important to understand the first point here, because when the volatility hit, it was not initially AI tech and OpenAI and NVIDIA. It wasn't that. It was actually what you first started seeing happen was after the initial sell where everything sold. It wasn't the traditional defensive sectors that started settling in first. Historically speaking, when we go through volatility due to uncertainty, and a lot of that uncertainty is typically central bank driven, banking driven, banking crisis, economically driven, obviously. But when those uncertainties happen, initially everything sells and then things stabilize first. And historically, what stabilizes in moments of true volatility is not aggressive tech plays. What stabilizes historically is boring food-based companies, utility-based companies.
Because how many times did you hear, well, because everyone's got to eat, right? Like, so no matter how bad things get.
3 Gs, baby, guns, gold, and ground.
Yeah. So
So those are traditional metrics, though.
That's how it used to be.
But for the first time here, before the AI trade took hold, you had a safety trade where it was Mag 7, the large moats. And for the first time, we saw that large moat argument being played out in the marketplace.
And Matt, I want to pat ourselves on the back because on our halftime show at Tackle Trading, we were the first people I saw in finance call this the new safety trade.
We were very.
We are a very small shop. We're a couple brothers. But the kind of, we were calling this the new safety trade, and that's exactly what it was. And that's exactly
anybody
what
that was part of our community, they know that. Anybody that was a listener of the podcast back then, they know that. But here's the thing, guys. As we have these open conversations on the pod, that's why we have these open conversations on the pod. That's why we talk macro on the pod, is so that we can figure out some of these big questions, so that we can be in front of others in the market who are, quite frankly, rinse and repeating arguments nonstop. They rinse and repeat headlines. But back to the two things that happened here. Number one was you had the safety trade in tech for the first time. And the reason he had it for the first time, Mark, and the reason you didn't have it in 2020, and the reason you didn't have it before 2020, in 2020, that was
because of AI.
Yeah. That was unique. But it wasn't just AI, Mark. Think about the amount of money that these companies have in 23 and 24 today versus 10 years ago. These companies' balance sheets could not withstand the downturns in the economy 15 years ago. They couldn't
individual countries.
The downturns 10 years ago. These are countries now.
These are countries.
And so for the first time, we saw them play out as a safety trade, and that was enough to hold it up. But it wasn't enough to propel it up. And then you had the NVIDIA report. And then you had the AI conversation that was led by NVIDIA and Taiwan Semiconductor through their earnings guidance. And so what you saw was, Mark, and again, here's the kicker, guys. Without this conversation, the market is not, RSP is not down just 15 points or 10%. The market's down 20 to 25% because tech sells. Because tech didn't sell, it held up RSP as well.
Yeah, and Matt, I'll be honest, I'm totally, because I did it in my Vikings class this week. I don't think you know this. Like, I did a whole thing on the technical structure of small caps and the Dow, and how, looking just from a technical, the structure looks pretty decent as far as like long-term moving averages acting as support. It never occurred to me, though, until this podcast live, because we didn't talk about this in depth before the podcast. We were more complaining about life. It never occurred to me that it was the AI is providing the backdrop for the rest of the market, and it entirely strikes me as true.
No, it absolutely is. Mark, in 23, in March and April of 23, I fundamentally believe we would have seen a bear market clip over 20% down if it wasn't for technology for the first time acting as a safe haven, and specifically large moat, big cap tech. And with the second point being the kicker, because once they got the kicker, Mark, look what happened to the S&P. It didn't just hold up against what the RSP was doing in terms of selling off. Once you got the kicker, it created a momentum environment that was unlike anything we've ever seen. And what occurred here was fascinating. There was about 3 months of divergence where the RSP went flatline and the S&P went up, 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 up. Now, what happened after that was equally fascinating, because tech, now eventually the markets get realigned. And obviously the next earnings season, what created the realignment. By the way, there was also uncertainty on the path to policy. But Mark, once all of a sudden, once the tech trade gets overextended on the long-term charts, guess what occurs? You see a little bit of stabilization happening, a little bit of down, but while they're going through a general profit taking in the short term, that solidifies RSP and the rest of the market, and then they get reconnected. And as you move into the future, you see how it kind of consolidates there. Well, then what happens? You start to see a little bit of catch up until here at the end of July, they're back to being reconnected. And so what occurs here is, and we're just seeing this. What occurs here is you usually get a trend on tech through a safety-driven trade due to the uncertainty, and then the growth kicker of AI, which it was NVIDIA last time and Taiwan Semiconductor. This time it's Apple and companies like Broadcom along with the NVIDIAs of the world. But as you first see that tech move go up, you do not question the tech move. You let that wave run. As it gets overextended, typically once it gets overextended, you'll see the profit taking, and mark that money's got to flow somewhere. And typically where does it flow? Right back into cyclical. And so if that's the pattern we saw in 23, how is that pattern today? Well, Mark, that pattern is the exact same thing.
It's the exact same thing.
Out today. It's the exact same thing. We're seeing divergence over the last 3 weeks. We're seeing technology take off in the time frame where everything else in the market is selling off, and we're having uncertainty in the market. Now, maybe it's not due to uncertainty on when the Fed, or like it was in 23, due to the dual-pronged approach of what is the terminal rate going to be at the Fed, and
but it's uncertainty, right?
Like it's uncertainty, and in that uncertainty, we're seeing the same thing play out. And so my thought here is, let's not question the tech move. It's being driven through AI growth initiatives. Let's let that get overextended. Let's participate. Let that get overextended. The rest of the market, let's let it go through its neutrality.
No, and the thing is, the rest of the market, because, Matt, why is the uncertainty there? Is it because of recession? Is it because of the Fed? You talked about some things in the newsletter, and I got to follow up. I have a linear thought of where I'm going. So why do you think that uncertainty exists?
Now, again, the divergence, and again, I think this is a pattern we'll see play out in the future. That's why I think it's so important that we understand it right now. I don't think this is not the first time. The first time we saw this was 23. The second time was right now. I think this is something in the future as well. That's why I'm spending so much time detailing it in the newsletter, talking about it here on the pod, because but I also think it's something that's really important for us to navigate right now. So first and foremost, how long can the divergence maintain? It can maintain as long as until tech gets overextended. And then it gets realigned through different patterns, different outperformance. It lasted 3 months last time is what it lasted. And that makes sense to me because earnings usually has a tendency to get the market back in some type of consistency. What do I think is creating the uncertainty? I think there's one very similar situation. Actually, I think there's two similar situations to the March example from 23. Number one, concern over the path of policy. Now, it might be a little different. Last time there was a debate and some uncertainty regarding what the terminal rate was going to be for the Fed. We had that debate for about 6 months until I got to the point where I'm like, guys, we're in a pause. They haven't announced it, but we're in a pause. That's what the Fed does. They don't announce it, but we're in a pause. And then all of a sudden, 3 months later, they're like, yeah, we've been in a pause for 3 months. But in that moment, we were debating the terminal rate. Are they going to raise? 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 What is that terminal rate going to be? This time, we're debating when they're going to start the cuts. So it's a vastly different conversation. One's on the top end and one's starting to cut, but you still have uncertainty over that. There is not clarification on the path of policy as of right this very second. Number two, back then it was right in front of our face. There was a banking problem. There was a financial crisis happening, and it was manifesting through Silicon Valley, but there were other regional banks out there as well. We had to run on banks. Mark, there is some concern in the regional banking side right now, but I wouldn't say it's the same concern as Silicon Valley concern from last year. And so there is some concern, but there's uncertainty in the path of policy. I also think there's some uncertainty from an economic perspective. And again, whether this is my worry, your worry, everybody's worried, nobody's worried, the market is worried a little bit that the Fed is getting the economic readings wrong. and that they may overshoot and create a Fed-induced recession.
Yeah, you hear a lot of credible people talk about that.
And quite frankly, I think they're lying. I do, because I think they're trying to. I shouldn't say that. I don't think they're lying. I think they're trying.
I like it. I think.
I actually think they're trying to influence the Fed. I think that's what they're trying to do. The market does this all the time. The market throws temper tantrums all the time at the Fed until the Fed pivots and gives the market what it wants. How many times have you seen that?
Oh yeah, come on. 2018 was the most graphic example of that. But
and then the last part of uncertainty. And again, not every worry you have is quote unquote uncertainty to the marketplace. Simply because you might be concerned about inflation doesn't mean the market's concerned about inflation. Simply because you might be concerned about the economy does not mean the market's concerned.
Yeah, and that's an excellent point, right? Because like it is obvious a month ago the market started trading differently, right? I mean, we've been breaking it down.
Well, I'd say 3 weeks, but yeah,
3-4 weeks, but it's been trading differently. It's been reacting to, the why of it is important to analyze, but it's important to get right too. Because if you think it's because insert political reason here, insert economic reason here,
the market care less about your mind, everybody's opinion of something. Remember, uncertainty is are questions the market has that needs to be answered. If you have a concern over the economy, it doesn't mean the market has that concern, because the market's concerns are not good or bad. The market's concerns are we don't have an answer to some data-driven question. Like concerns are not always bad. They're not good. They're neutral. Concerns are data. We need to get more data so that we can understand the environment, so that we can project and execute our trading philosophy, systems, rules. It's very difficult for professionals to execute their trading systems and philosophy if they are uncertain of the landscape in the future. And so the uncertainty is not necessarily negative. It is just
it's just uncertainty,
right? But I see a lot of times people will misunderstand their fears for market concerns, and those are not the same thing. Your fears are your fears. Your understanding is your understanding. It does not mean it is shared by the market participants. And so uncertainties are market questions that we do not have the data necessarily to determine an outcome. And as that data comes in to determine the outcome, the uncertainty is removed and the market has a tendency to get back into a normal market function, meaning the divergence is now eliminated. That's what concerns are and uncertainty is. It is not always negative. It oftentimes is resolved to the positive, quite frankly, because concerns are built out of some fear, lacking data, and oftentimes the worst case scenarios don't actually manifest themselves, much like last year in March when Silicon Valley got basically gobbled up by JP Morgan, and all of a sudden the banking crisis was resolved and the markets got back realigned. Mark, something similar will happen again, whether it's the earnings environment or an economic report or the central bank makes a policy statement that gives us clarity. It will happen again. And by the way, the third uncertainty right now, so you got the path of policy being one, you got the path of policy creating a Fed-induced recession concern number two, and that's simply because the Fed hasn't told us what's going on, and the economic reports have been a little bit on the downside lately. And then the third one, you have some geopolitical unrest out of Europe right now. To go on my point, Mark, just let me finish this one point here. Think about what I just said about concern versus fear, uncertainty versus fear. Mark, would you agree that the Israeli-Hamas situation is a concern for everybody around the world?
Yes, absolutely, 100%.
Would you agree that the Ukrainian-Russian war, regardless of your personal philosophy on who you support or not, is a concern for everybody around the world.
Yes, I don't care what
But
your take is.
would
It
you
is.
describe it as an uncertainty for the market?
No, market's not trading on it at all.
Mark, would you suggest that the Israeli-Hamas military conflict, the Russian-Ukraine military conflict, is a bigger concern for the world and humanity than the French parliamentary election chaos right now?
Yes, of course.
Okay, but which one of them is a uncertainty?
But which one of them could create market volatility next week? It's the new one.
French election.
It's the new one because the market hasn't processed that yet.
Exactly. When the Russian situation happened a few years ago in February, it was a big uncertainty. But once those uncertainties become normal,
and there was a day, Matt, and I remember having a conversation on the halftime where we reported about this with you, where we both said there is going to be a day coming up, the market stops trading on this, and then it probably never trades on it again. And that's exactly what happened.
And we will stop talking about it.
And we will stop talking about it because you remember the conversation too, right? Like, and that's exactly how it played out. And that's exactly how the Europe thing will play out as well, right? There could be some headlines on Monday, Europe, France, yeah. And then one day the market will stop.
Personal concerns that are not market concerns, right? And so there is a difference between personal concerns and fear versus what true uncertainty is, because true uncertainty, we're trying to figure out an answer to it. We're trying, once we get the answer mark to any uncertainty, we just price it in and move on. If the answer is negative, the market goes down, we price it on and we move on to the next report. If if it's positive, we price it in, we move on to the next report. We're seeking for an answer. What answer are we trying to find on the Israeli-Hamas conflict? Like that's just going to be an ongoing situation until they have a ceasefire. Same thing with Russia and Ukraine, right? Well, with the French parliamentary situation, why that's a little bit more of a concern, an uncertainty right now, and not just a concern, is because we need to find some solutions to that. And right now we don't have any. So there is a difference between concern and an uncertainty. An uncertainty for the market is trying to find the data to find the solution so that they can project what the future holds. That's what all of this is about. And in these times, moving into the future, big cap tech plays. So again, I know this has been a long conversation with a lot of.
Yeah, but it's a big one. And Matt, it is a really bullish conversation when you, and I know you hate it when I do this, but it leads to bullish analysis. You know what it took? So last year, if we play that analogy out, right, where you had tell of two markets, cap leading, everything else lagging, this wide, and then eventually it took, in order to break and even cause severe downward movement, which we did have severe downward movement, Matt, it took dollar and yields going parabolic for 7 straight weeks to finally crack and create any real pressure of selling in tech in particular. Like, it took a massive macro move to break that. It would take a similar thing to break that. In my opinion, in listening to this, that's the takeaway I have.
I do think the end result is a bullish move, but again, I want to be clear on this. The pattern suggests you let the tech move play out. You don't question it. You let the tech move play out, because what's driving it is two things: safety driven, large moats, and the AI growth kicker. What is unique about
which is exactly as last year.
And what is but you're right, 1000% you're right. But what is unique about it today versus a month and a half ago? Because a month and a half ago, Mark, the entire market went down. The entire market went down 5%. It wasn't like, oh, everything went down, but tech went up. Everything went down. Just a few months ago, it did. The market was not divergent. So what created that divergence? It was not just one or the other. And that's the point. You need them both to create the divergence. You need the safety trade plus the growth kicker. And unlike 3 months or 2 months ago, Mark, you didn't have NVIDIA's 10-to-1 split. You didn't have Apple joining the Apple Intelligence AI arms race, which you had this week. You've had multiple different reports in the last couple of weeks, specifically on AI growth. You had Apple make a deal with OpenAI to radically change Siri and how AI functions. You're going to have a complete upgrade cycle on Apple on this. And so it's not just the fact that when the market gets a little bit spooked, oh my goodness, Apple and everything else goes up because they got a large moat. No, it's a divergence created because two things, not one. One, you have a growth argument for AI right now because of the information that has came into the market over the last 2 to 3 weeks, in conjunction with the increasing uncertainty provided by the central bank, which is added to that trade because they are now seen as safety-driven trades. And in that environment, there is only one unique historical comparison, and that is March of 23 to June of 20.
Yeah, and I want to emphasize this from a historical geek standpoint. If you see anyone reference market breadth and how it's bad and list anything before March of 2023, they don't get it. They don't get it.
If they're not anchoring against the 23 historical comparison, they don't understand.
All other previous market breadth examples are null and void. They're irrelevant. Like, it's apples and oranges.
It is apples
and NVIDIA's.
It's apples and something. It's apples and something. And again, I know that, we spent the entire podcast talking about this one conversation, but I think this one conversation is important.
Matt, I have a sneaky feeling that it's going to take for everything else. Because play tech patterns, I'm keeping my eye on everything else as well, because if you see a catalyst, whether it is a Fed that does communicate clearly, if you see an earnings season that is solid, right? Oh gosh, dang! If you see the combination of the two,
see, the excitement here is not the tech trade. Don't get me wrong; I'm very excited about the tech trade. But that's an ongoing situation, right? That's an ongoing situation. The exciting thing coming out of this is the catch-up situation.
Yeah, you and I, we did not talk about this. We have the same thought.
That's the exciting part. It's when the markets remove the divergence and they get reconnected.
Yeah,
it's not like tech all of a sudden.
That's the big trade, because Matt, and I'm going to tell you why. I'm going to tell you why. It's because for people like me, listen, I'm going to have a tech trade. I'm going to play puts on the index. I'm going to try to find a way to make a buck, but I'm not putting my whole account in tech.
You're not going to go chase the high flyers out there right now. No, of course
no. And so there is a limited aspect in which
me, Frank, and the Delta Dogs will
yes,
we will, but there's we're the weird ones.
Yes, and I've done. Listen, my accounts hit all-time highs this week. For me, I usually don't do this well in this kind of breadth things because I have other things. Caught this one pretty well. Oh, I don't know. It might be because I listened to the freaking Trading Justice podcast, right? Participate in a great community.
Because we did not talk about this, but I did research on this. Was my explanation, did it help you understand?
It did, because I laid the foundation of this in my Thursday Cash Flow Vikings trading lab, but I didn't have causality.
Yeah.
I had the study of the patterns.
You had the price action.
I had the price action. And so and you know me, I'm not spend all the time on technicals. I spent almost my entire class on technicals comparing Dow Russell 2023 patterns. This was on Thursday, to the current situation and pointing out the similarities and the goodness and structure. What this did is this helped give me some causal reasoning that I absolutely buy, right? Yeah. This is the freaking bullish market. Price action in RSP isn't bullish.
No, but again,
this is a bullish market.
Mark, the divergence, it wasn't 3 weeks in divergence. The divergence in the 23 pattern lasted for about 2 months. and then they reconnected.
And maybe this one lasts 4. Who knows? I don't know.
Honestly, it's not like we have a lot of historical comparisons to.
We have one.
Like, to me,
we have one.
I kind of feel, honestly, this is, it's not a timing aspect. It's an understanding of the environment aspect. And to me, when you're looking at the, 3, 4, 5 weeks down the road, what can connect these things, I don't think anything out of the central bank can connect these things, because I think the central bank has told us they're data dependent. Until
they're just not going to do anything. That, I mean, okay. I saw those speeches on Thursday and Friday. They're afraid. They're afraid to make a call today. They're going to need another inflationary report.
I do not understand why those dudes and girls have jobs. I really don't. I
don't either.
I don't understand it.
They're not good at them.
And it that because you're right, they're scared to act.
They're scared.
They want the data to give them the information they need.
Matt, and it's the 1-2 punch. It was they were wrong on transitory, and then they were wrong at the start of the year when they were celebrating.
Listen,
and they're terrified.
Hit or swing, baby.
They are terrified of that, and that is impacting them. They're terrified, so they're going to need.
I get it. They're terrified. I get it. But again, if you're terrified, you shouldn't have the job as being one of the most important people in the world. That's all I'm going to say. I was trying to criticize the Fed there. I forgot what I was going to say on my point here. But again, I think in the short term, let's ride tech. Let's ride.
But you and I are both excited for the catch-up.
Catalyst. The one catalyst
because Matt
coming up is earnings, bro.
Yeah.
Earnings unite.
Matt, November, December, January, February were fantastic money-making environments. Holy cow. They were fantastic. And why were they fantastic? Because you had broad participation. And when you have broad participation, it's not just that everything's doing good. It's that things are taking turns setting up in patterns. Mm-hmm. And so as one pattern comes to an end, here's something. Right now we got tech. All right, what pattern does tech have? Does it not? Netflix breaking out. I can do something. Great, right? Yeah. But when you have everything broadly participate, it just provides so many opportunities just in the rotation of patterns. So
the technician in me could have described this argument in 5 minutes. The fundamental behavioral analysis in me needs to understand it so I can apply the technicals, though. And that's what this conversation
did. It helped me a lot because it just makes sense. And that's why I said that when you break down this conversation to its roots, and this is a very bullish conversation.
The conclusion is
the conclusion
opportunity. And again, I'm not talking like I don't have
not in the next 2 days
30% down either.
Yeah, who knows what happened? I mean, for all you know, Monday morning markets open and the headlines are European in crisis markets. Whatever. Right.
Listen, the markets are in a economically sensitive mode. We could see some volatility here. But Mark, isn't it as simple as this though? You just wait for tech to get overextended, start to show slowing momentum, while at the same time the cyclical areas start to show slowing momentum to the downside. And at that point, don't we just reverse and rotate?
Yeah. I mean, and this is where tactically, and this will be my final point. Like, me, I tend to bottom dip a little bit more than you, in the sense that a lot freaking more than you. So I could see some naked put opportunities in other stuff, right? And some small plays.
Talk about confirmation, you don't.
Yeah, and so, but that would be the tactical difference. But
Big macro conversation here in the pod.
I don't even know if it was a macro conversation, bro.
Macro conversation.
I think this was like a price behavioral conversation,
I see it as a behavioral. I see it as analysis. I do. In the newsletter, I talked about it from a behavioral aspect. I talked about how every degree of analysis we do, whether it's fundamental economic or technical, to truly understand it, you have to understand what creates the analysis in the first place. And that's behavioral analysis. And so like, don't get me wrong. I'm jealous oftentimes of technicians like Frank who can just see a big green candle and be like, that's momentum. Me, I
Yeah,
have to
I'm the same way.
understand the why behind the
I
green.
have to understand the why.
And so that's what this conversation.
And you helped me understand the why. You did.
Well, I'm glad, because it took me a while to get to.
No, no, it was a light bulb moment for me. It was like, oh, of course these areas are not going to. Yeah, it was a light bulb moment for me. So,
Well, and again, anybody can point to a historical environment and said, ooh, that went up and that went down. What I'm trying to do is understand the why of that, and if it's a repeatable pattern in the future.
and who knows, like, how many waves of this we get in the coming years? But this is wave 2, and so we'll worry about wave 3 when it.
You know my philosophy. I think we're going to get a few of them.
Yeah. So we'll get a few of them. I just want to spend 5 seconds on Go before we wrap up the podcast. Matt, is it a day that ends in Y?
You stole my joke.
You stole my AI guy. So there, eat it. So yeah, buy some if you don't own some. It was great.
My daughter opened up an IRA, and we were designing her portfolio, and she was allocating about, a couple of years worth of, allocations in there. And her first 2 positions, Mark, were IAU, the ETF for gold, and GDX, both 10% positions each. She took a 20% max position. She asked me why she couldn't go more, and I said, I'm so proud of you.
You can't go more because.
Well, I said you can't go more, honey, because you're gonna want some other things.
Like you just can't, because you just can't.
You only got so much.
Like, that's a conversation for another day. Matt, send us out.
Hopefully you've enjoyed this conversation here today in the Trading Justice podcast. And if you do, if you're watching it on our Tackle Trading YouTube channel, we truly appreciate the like and the share. It helps us out with that constant battle with the Google algorithms. And if you're listening to it on some podcast app near you, we love you guys. Thank you so much for being the best part of Trading Justice and our tackle trading community. We are nothing without you guys, our community, our team members, our students, our listeners. Just so much appreciation for each and every one of you. And I truly hope you have a wonderful, wonderful week. And if you need anything from us at Tackle Trading, you can email us at team@tackletrading.com. Also, go ahead and hit us up on our Tackle Trading YouTube channel as well, as this podcast gets posted there every Sunday morning. So make sure that you mark your calendar for every podcast update as well. And here in a couple weeks from now, I will be giving an AI presentation on our YouTube channel as well. We're finalizing the date and time for that, but we'll have more information coming to our community very, very soon. So get excited. We're going to be doing an AI marketplace webinar. AI 101, AI Gold Rush. Actually, we know the name of it. It's AI Gold Rush. So that'll be a couple weeks from now on our Tackle Trading YouTube channel. I'll have more information next week in the podcast for that as well. With that said, I hope everybody truly has a wonderful, wonderful week. And if you need us from anything, hit us up.